All right, let's jump right into this explainer. If you're currently leading a corporate finance team, I'd bet money you are breathing a massive sigh of relief looking at IFRS 19. And honestly, it totally makes sense. It's designed as this genuine relief mechanism to strip away disclosure requirements for non-listed eligible subsidiaries. It feels like a massive win, right? Well, actually, scratch that. Beneath that serene surface of simplified reporting, there is a silent, massive operational trapdoor just waiting to spring open. See, if your group uses management-defined performance measures, we'll call them MPMs from here on out. Relying blindly on these exemptions could trigger a severe data crisis. We're not just talking about a minor accounting policy tweak here. This is an absolutely urgent institutional infrastructure challenge.
The contrast between what finance teams expect right now and what the standards actually demand is honestly staggering. The illusion is that IFRS 19 gives you this clean, open door to just exit the complex disclosure rules of IFRS 18 for your subsidiaries. But the second you walk through it, bam, you hit reality. You hit the MPM trap. Now, to be fair, IFRS 19 does reduce narrative explanations. Those reductions are completely real. But it absolutely does not reduce the MPM reconciliation requirement itself. Meaning, if a subsidiary presents an MPM, or even if group-level MPMs map heavily down to them, that heavy compliance chain, yeah, it is still fully attached. So the absolute most crucial thing to understand here is the timeline, because the clock is literally already ticking. IFRS 18 is effective for annual reporting periods beginning on or after January 1, 2027. But here's the kicker. It also applies to interim financial statements in that initial year. That means your very first MPM disclosure obligation actually hits in Q1 2027. And European regulators, specifically ESMA, the European Securities and Markets Authority, they've already made their expectations crystal clear. They expect groups to complete their assessments in the first half of 2026. So if your game plan is, oh, we'll just sort out our alternative performance measures by year-end 2027, that is simply not going to cut it. This is a right-now challenge.
Let's define exactly what this trap actually is. I kind of think of it as the ultimate accounting Trojan horse. The IFRS 19 MPM trap is basically the requirement to reconcile every single MPM to the nearest IFRS-defined subtotal. And crucially, this reconciliation has to include the income tax effect and the effect on non-controlling interests, or NCI, for each individual reconciling item. And guess what? IFRS 19 offers zero meaningful relief for this. None. It just so happens to be the single most operationally demanding requirement introduced by IFRS 18, and it remains 100% intact for your subsidiaries.
And this brings us to the real twist. People look at IFRS 19 and they immediately think of it as IFRS Lite. But it's not. Recognition and measurement stay exactly the same. This reflects a very deliberate design choice by the IASB. Essentially, if a subsidiary uses MPMs in any public communications, the strict discipline introduced by IFRS 18 applies in full. Assuming that your subsidiary level is somehow magically shielded from complex MPM tracking creates a massive disclosure gap. It's a dangerous illusion, and honestly, it can entirely break your consolidation process.
Let's trace the data lineage here to see exactly where the whole thing breaks down. Imagine at the parent group level, we have a goodwill impairment of 100. To calculate the MPM reconciliation, the parent group cannot just grab that top-level number. No way. They need to know exactly where that impairment arose, what the applicable tax rate is by jurisdiction, the NCI ownership percentage, and the tax deductibility. But if you look at the standard consolidation packages flowing up from subsidiaries today, they only capture entity-level data. That hyper-granular breakdown just isn't there. The data lineage absolutely must run from the subsidiaries upward at the specific adjustment level if you want to produce an auditable reconciliation.
Think about how this builds into an absolute practical nightmare for a second. We're talking item-level requirements, subsidiary origin, specific tax rates, NCI ownership, tax deductibility. Now take all that and apply it to the most common culprit we see in practice, impairments of cash-generating units, or CGUs. Imagine multiplying that single CGU impairment across various restructuring costs or acquisition-related expenses. Every single one of these arises in completely different jurisdictions with completely different NCI structures. You literally cannot piece this data together with some manual year-end spreadsheet patch. It's impossible. It demands a consolidation package that's been fundamentally redesigned to capture adjustment-level attribution.
Which brings us to a pretty harsh truth. It's perfectly captured by the implicit signal the IASB is sending us. Use MPMs deliberately or do not use them at all. They didn't outright prohibit MPMs, but by forcing these hyper-specific item-level tax and NCI calculations, putting them strictly under audit, and explicitly declining to provide any IFRS 19 relief for them, well, the standard setters are sending a massive message. The discipline required here is immense. Continuing to operate with a fragmented, pieced-together data infrastructure just isn't viable anymore.
Now, you might be wondering, why is this such a blind spot for so many organizations? It basically comes down to classic corporate structure. And there's a deep irony here. The larger and more complex your global organization is, the deeper the silos are between your departments. Over on one side, you've got investor relations, moving at lightning speed to shape market narratives. Over on the other side, you've got consolidation and accounting, completely focused on statutory books and strict compliance. Historically speaking, these two groups probably only talked at the company holiday party, right?
But that dynamic has completely changed. Under IFRS 18, the boundary between external communications and audited financial statements basically vanishes. Every single earnings release, every investor day presentation, every subtotal of income that IR uses, it's all a potential MPM. IR often dictates these non-GAAP metrics to the market without even realizing the massive, heavy data gathering chain they're forcing onto the accounting team. Let me be blunt. If your IR and Consolidation teams aren't actively talking right now, you are walking straight into a reporting train wreck.
Okay, so how do we actually fix this? We've put together an actionable 3-step compliance blueprint for you. Step 1, audit and align. You need to force an immediate meeting between IR and group consolidation to audit every single MPM plan for your communications. Tear down that silo today. Step 2, map the data lineage. Trace those group-level MPMs all the way back down to the subsidiary entities so you can see exactly what triggers the full IFRS 18 disclosures. And Step 3, automate architecture. You've got to upgrade your systems. Move away from those manual spreadsheets and implement automated accounting layers that can track these item-level effects continuously throughout the year.
When you boil it all down, it really comes down to a strict binary choice. There's no head and third option here. You either redesign your consolidation package to support auditable MPM reconciliations using hypergranular data, or you redesign your IR communications to entirely eliminate the measures that trigger this brutal framework in the first place. You cannot preserve your current IR approach while keeping your current consolidation architecture. Something has to give.
Let's bring this all back to ground zero and remember that timeline, Q1 2027. This trap really only becomes visible when you read IFRS 18 and 19 together and physically map your group's legal structure against it. For a lot of groups, building the necessary data infrastructure across multiple jurisdictions and all those NCI layers is going to take way more time than they realize. Waiting until the end of 2017 is just a recipe for absolute disaster. The time to either build the infrastructure or radically change your external communication strategy is today.
So I'll leave you with this absolutely vital question. Is your organization actually prepared for the granular requirements of IFRS 18 and 19? Look, IFRS 19 is a fantastic framework for reducing reporting fatigue, for sure, but only if you deeply understand its boundaries. You have to treat this MPM overlap not as some simple accounting policy choice, but as an urgent enterprise infrastructure priority. Align your teams, audit those data pipelines, and whatever you do, please don't get caught in the MPM trap. Thanks so much for joining me for this explainer, and seriously, go get your IR and consolidation teams in a room together this week.